Welcome to this week's live chat session for FIN4443, Financial Policy and Strategy. In this lecture, I'll walk you through some helpful tips for tackling the Week 3 discussion board assignment. Our focus this week is dividend policy and stock repurchases. Both are key parts of a company's financial strategy. Let's dive in. Dividend policy is basically a company's playbook for deciding what to do with its profits. Should the firm return earnings to shareholders in the form of dividends, or should it keep the earnings and reinvest them to grow the company? There are two key decisions here. First, how much to pay out in dividends over the coming year, and second, what the long-term payout ratio should be, the average percentage of earnings returned to shareholders over time. These decisions are central to the firm's value strategy, and they will be important when analyzing the company you select for your discussion post. Now let's talk about two competing schools of thought. Dividend irrelevance theory, famously proposed by Modigliani and Miller, says investors don't really care whether their return comes from dividends or from capital gains. Under this theory, dividend policy really does not affect the firm's value. However, according to the relevance theory, dividend policy does matter. Why is this? Because investors have preferences. Some want cash now. Others prefer to delay taxes and grow their wealth through capital gains. As you research your company this week, consider whether its dividend strategy is in alignment with its shareholder base. This graphic provides a visual reinforcement of the two competing views we discussed. In your discussion post, you'll want to take a position. Does the company's dividend policy seem irrelevant, or does it clearly impact investor sentiment and firm value? Here is another angle: dividend signaling. The idea is that dividend changes send a signal to investors. When a company raises its dividend, it might be signaling confidence in future earnings and cash flows. A dividend cut, on the other hand, might suggest trouble lies ahead. This concept ties into game theory. Strong firms are more willing to send confident signals than are weaker firms. If the company you're analyzing has recently increased or decreased its dividend, you might explore what kind of signal that sent to their investors. The clientele effect suggests that different groups of investors prefer different dividend policies. For example, retirees, pension funds, and endowments often prefer high payouts. They need steady income and may not be heavily taxed on dividends. Younger investors, or those in high tax brackets, might prefer lower payouts and higher capital gains. As you evaluate your firm, ask yourself this: who are their shareholders, and how might that shape their payout decisions? According to the free cash flow hypothesis, firms should return excess cash to shareholders when there are no good projects in which to invest. If management is trusted, a dividend cut might actually be a good sign. It means the firm is pursuing positive net present value projects. But if trust is lacking, cutting dividends could be viewed as a red flag, suggesting the firm is investing in negative or low-value projects. So again, context makes a difference. Consider how markets reacted to any recent dividend changes at your selected company. Why companies sometimes buy back their own shares of stock. Shifting our discussion now to stock repurchases. Reason number 1. When a company has more cash than it needs for additional capital investments, it may repurchase shares to return value to shareholders. This is especially likely if the firm believes its stock is undervalued. Second reason, to adjust the firm's capital structure. If the firm has too much equity and not enough debt, it might borrow funds and use the proceeds to buy back shares, bringing its debt-to-equity ratio back in line. Reason number 3. Stock options. This third reason is used to cover stock options and other similar compensation programs. If a company expects a lot of employee stock options will be exercised soon, it might repurchase shares to avoid diluting ownership. Reason number 4. Protection against hostile takeovers. Stock repurchases reduce the number of shares available in the open market, thus making it more expensive for a third party to gain control. Here's how that works. When buying back its own shares, the firm increases demand and thus drives up the stock price. This raises the cost of any acquisition attempt. Also, repurchasing shares concentrates ownership among insiders, giving them greater control and the power to block any unwanted external takeover bids. So here's the big picture. As you write your discussion board post, be sure to identify which dividend or repurchase theory best aligns with your company's observed behavior. Use real data to support your argument. Was the dividend increased or has it been cut? Did the company repurchase shares? And if so, why did they do that? Be sure to back up your discussion with references in APA format, and remember, this assignment is a chance to show that you understand how real-world firms apply the theories we've discussed. As always, if you get stuck, just shoot me a message. Best of luck, and I look forward to reading your posts.